Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, one of the founding members of the Dividend Kings marketplace service on the financial site Seeking Alpha. This is a subscriber request series, Analyze Out Loud video covering Tesla, probably one of the hottest, most popular stocks on the planet. They literally have made electric cars cool, which hasn't been prior to Tesla. And these are just some of the models the company has. But I'm going to tell you that Tesla is a very interesting company to evaluate. As I suggested in the written portion here, it's really a tale of two companies. Tesla from inception as a public company till now, and then Tesla going forward. And I do believe it really needs to be thought of and looked at in both of those situations. So let's go ahead and go to FastGraphs and look at Tesla from a fundamental perspective. First of all, the company went public in June of 2010. And by the way, their performance since going public has been extraordinary. The company has averaged almost just under 44% a year total annualized rate of return. But a lot of that happened just in the last several months. If I look at Tesla from inception through the beginning or the end of May of 2019, the company still did extremely well, but the annualized rate of return was something closer to 26% rather than 44 or 45%. Obviously, we've had this parabolic advance. As I mentioned in the written portion, the company has risen over 300%. That's an annualized rate of return for this period from May of 2019 to February of 2020 of annualizing at 623%. Now, the reason I bring this up is to point out that this enormous advance here, and it was parabolic from the point of view that we had this huge drop and then this tremendous run up, and it's even gone beyond that. So the point is that it would have been great to have been owning Tesla during this period of time, but if you're looking at investing in it today, you do have to consider what's happening. Now, I want to talk a little bit about the future, and I'm using adjusted operating earnings here. I want you to notice that the analysts are expecting enormous growth for the next couple of years on Tesla. So let's go to the forecasting calculator and let's look at it from a standpoint of growth. Now, there are 27 analysts that expect, I don't even know how to read that, 27,933% growth from 3 cents a share to $8.41 a share, and then $13.53 a share in 2021, followed by $19.56 a share. But I also want to point something else out. From a standpoint of fundamental value, the company trades at a blended PE ratio of 609, almost 610, we'll call it. That's amazing. The earnings yield is 0.16%. What that means is if the company gave you all of its current profits, your return would be 0.16%, only 16th of 100th of 1%. So, that's obviously, it's really not about what the current value is. Now, where the company gets interesting is looking at the future. So let's check a couple of other estimates services here. Let's look at Yahoo estimates. And let me go back to the earnings estimates here. We see what I gathered from FactSet. So we have 841 for 2020 and 1353. If I go to Yahoo, which uses Reuters, I get 828 and then I get 1381. So the numbers are a little different, but they're very, very similar between the two. So we are looking at a company that does have expectations by most analysts. There's actually quite a few analysts following the company for significant earnings growth. Another service that I can check, because I'm a subscriber, would be Seeking Alpha. So I can go into here and look at their earnings and look at their earnings estimates. And they also are providing forward estimates. They have a lot of analysts, again, 27, 25, and then it drops to 14 in 2022. They're saying 853 and 1487. So, 841, 843, 1353, 1357, those are all basically the same numbers. But even at those numbers, the company would have a growth rate of averaging about 29% going forward, and that would make the current PE ratio very, very high. But let's look at Tesla from other perspectives here, because I think this is also critically important. One of my favorites, or one of Warren Buffett's favorites, I should say, would be to look at it from a standpoint of owner's earnings. Now, owner's earnings would include estimates for maintenance CapEx. Now, keep in mind, this is an automobile manufacturer, amongst other things. They obviously are involved in other solar power and electric power sources. But the point is is the owner's earnings estimates are expected to be significantly high going into 2020 and then rise again another 10% in 2021 before they begin to collapse. And that's primarily a function of CapEx. So if I look at it from a forecasting point of view, from an owner's earnings point of view, Tesla would actually be very cheap currently and offering very significant short-term rates of return out through 2021. It gets a little dicier if I go out to 2022, but keep in mind I've only got one analyst here that's making this forecast on owner's earnings. So from a perspective of owner's earnings, Tesla looks very, very intriguing to say the least. Now, when I look at GAAP earnings, or generally accepted accounting principle, diluted earnings, we see also tremendous growth potential in Tesla, but again, at a much more muted rate, closer to that 30% we saw with operating earnings. That would imply if it traded at, let's say, a 30 PE, of course, that's from a current PE that is ludicrous, then the company would actually generate negative rates of return. But if I look at it from a longer term growth perspective, I'm sorry, I don't get that with GAAP. I might get a different picture. I was thinking about operating cash flow. Let's look at operating cash flow. Operating cash flow is also important. It's also expected to grow at about 25%. This would indicate that you could make maybe an 8% long-term rate of return. But the point would be, it would be these near-term numbers where there's a potential to see significant drops in value or in your long-term total return over the next couple of years, just looking at cash flow. Now, when I look at long-term cash flow, that's what I was trying to do with the GAAP earnings. The rates of return could be extraordinary. So again, it's a tale of two companies. It's also a tale of a lot of different metrics here. Let's go ahead and look at free cash flow just for fun. And when I look at Tesla from a standpoint of free cash flow, I also see expectations for strong growth going forward. Not quite as strong as we saw it's about the same growth rate, but not as high a level as we saw from the operating cash flows. But nevertheless, we are expecting to see some significant growth. And that's part of what has the stock, postured at such a high valuation currently. And then finally, let's go ahead and take a look at EBITDA, or earnings before interest, taxes, depreciation, and amortization, and look at it from an EBITDA standpoint. Tesla actually looks extremely inexpensive right now, especially from the long term. That's your long-term estimate, and this would be your more specific estimates for the next couple of years. This is really, again, a kind of a soft cash flow metric. So Tesla is really a very, very interesting company at these levels. There's an awful lot of long-term opportunity here, but you also have to take into consideration the fact that the stock price has tripled here in just a matter of a few short months. Now, I do want to make one final note here by looking at the stock price, if you will. We have had a slight correction, and the stock has fallen from its peak high. That trading at about $7.99. If I get a quote on it currently, I'm looking at Tesla trading at $7.95. It's down another 0.6%. This is Wall Street Journal. I believe this is a real-time quote. So, it's a very interesting story. It's a very interesting picture. I think it would be a speculation, and my only concern is long-term it could be great. Again, there's a lot of stuff has to happen for that to be true. Short-term it could be dicey if any bad news comes out, and of course we have, as most of you probably know, a very provocative CEO, so just about anything can happen on the stock in the short run. But, it's an interesting stock, and one that if you want to speculate, fine. If you've owned it for a long period of time, I'd probably suggest holding it. If you were thinking about investing in it for the longer term, I might want to look at it at a time when maybe we get a little better entry point. But nevertheless, it's kind of an interesting stock to look at from fundamentals. Past fundamentals have been weak. You see a lot of negative earnings growth at very relatively high levels in past years. You see a few little spurts of positive profitability, but now we are expecting this enormous profitability going forward. As I said in the article, buyer beware, caveat emptor. Anyway, it's Chuck Carville saying thanks for watching. If you like what you saw, please don't forget to hit the subscribe button and subscribe to our YouTube channel. We've got more videos like this coming. Thanks again.